And the global growth story comes on the aspects of a lot of different facts that we're dealing with right now, whether it's trade with China, whether it's the slowdown, and what Wilf was just saying, the inability of the ECB to really protect against a much broader slowdown, what we have going on in other areas of the world. And in fact, if you look at some of the data that we got today in the U.S., the PMI data, while it was still above 50, it was weaker than expectations. So I think that's the broad concern that we see here. There really is nowhere to hide inside of this market. Everything is down, including utilities. We're going to look at this. We had over $80 billion in redemptions this week from equity mutual funds and equity ETFs, and you also had $13 billion in redemptions this week out of bond funds. Where's that money going? It's going to cash. So you see that going on right now. People are scared about the global growth story, and they're just going to cash.
Michael, you still think that interest rates is the biggest cause for this sell-off, more so than global growth. Is that right?
Yeah, I think it's a significant factor we haven't touched on lately. You guys have, in your earlier segment, and you've hit on all the negatives. I can't even add any more. Tax loss selling at the end of the year, I guess, maybe. They've been clearly defined. But they are sentiment, their psyche, their psychology right now. I think, and they're all real. I don't want to misstate them, but there are some positives. I mean, corporate earnings, ex the tax cut, are still expected to grow next year. You have CapEx spending. You have low unemployment in the U.S., you have U.S. growth that really hasn't fallen off a cliff yet. You alluded to the GDP growth of 3%. And those are fundamental factors that I think are being discounted right now in this year-end process we're going through. They are real as well. And so I think what it all amounts to is markets saying, what have you done for me lately? And adding up to a swirling situation where you got to be, defensive at some level, planning for losses, but also preparing for gains as well. Because I really don't know you can game plan this right now.
So, Rick, as we try to interpret all the data coming from around the world, including the U.S. today, what kind of signals are you getting from the bond and currency markets, both getting bought, treasuries and the dollar today, as far as where we're headed next on stocks?
Today, rates were really firm. Ranges were on the tight side, and, treasuries, especially the long end, holding in nicely, 7 or 8, 9 basis points off their intraday low yields over the last week or so. And I think that's very significant. Many believe, including myself, that a large portion of the drop in rates was probably due to shorts in the market liquidating. The big move into money markets is coming out of monies from both the yield curve, the treasury complex, and the stock side. Ultimately, the dollar was the big feature day. It was up close to 0.5% on the week. It's now up about 0.3%, and it's just below making new fresh highs, not only for the year, but going all the way back to mid-2017. I think next week's Fed meeting will be very critical. They should raise a 1/4 point. I would like to see how the fallout on the yield curve is, especially maybe 0 through 7 years. I want to see how the 3s, 5s, and 7s all react. But at the end of the day, I really do think retail sales today, especially that control number up 9/10, shows us that divergence doesn't mean that if the globe is shrinking, the U.S. has to shrink at the same pace. And I think it's that relative measuring of how much we are affected by the global pull of the rest of the globe's more weakened fundamentals versus ours, which aren't as good as they were, but definitely solid by comparison.